Think about the last time you looked at your bank account balance and felt genuinely confused about where your money went. You know you were paid. You know the amount that hit your account. You have a general sense of what you spent on. Nothing extravagant. Nothing that obviously explains why the balance looks the way it does now. But somewhere between the deposit and today, the money distributed itself across the month in ways that do not obviously connect to any deliberate financial decision you made. It just went. And the savings you intended to build this month are once again smaller than you planned or non-existent entirely. The people who consistently build savings, hit financial goals, pay their bills without stress, and have genuine clarity about their financial situation at any given moment are almost universally people who have built a specific account structure that separates money by purpose before it can be spent on the wrong thing. Not because they have more willpower, not because they earn dramatically more, because the architecture of their banking system does the work that willpower was never going to do reliably. Today, we are going to build that architecture. 5 specific accounts, each with a specific role, each serving a function that none of the others can, working together as a complete financial operating system that makes saving automatic, spending intentional, and wealth building structurally inevitable rather than aspirationally dependent on daily discipline. Welcome to Klux One Finance. Let us get into it. Before we get into the specific accounts, let us understand exactly why the single account or the 2-account model fails. Because understanding the failure mode makes the solution obvious in a way that just being told to open more accounts does not. Account separation solves this by making the more relevant question the only visible question. When your spending money is in one account and your emergency fund is in a separate account at a different institution, the emergency fund money is simply not visible when you are making a spending decision. It does not register as available balance because it is not in the account where spending happens. The architecture removes the temptation by removing the visibility of the money that is not available for spending. This is the same principle that makes retirement accounts so effective at building long-term wealth for people who would otherwise never manage to save voluntarily for 30 years. The money comes out of the paycheck before it ever hits a spending account. It goes to a separate account at a separate institution with penalties for early withdrawal. It is structurally inaccessible for spending, so it accumulates. Not because people are paragons of patience and long-term thinking, but because the architecture makes accumulation the path of least resistance and spending the path of greatest friction. We are going to apply this same architectural principle across all 5 accounts. Account 1 is what I call the income hub, and it is the command center of the entire system. This is the account where your paycheck is deposited, where all income arrives first, and from which all other accounts are funded. It is a checking account at a bank with a strong online and mobile banking interface, no monthly fees, and reliable ACH transfer capabilities. The income hub is not where you pay bills from directly. It is not where your emergency fund lives. It is not where you keep your spending money. It is the receiving account and the distribution account. Money arrives here. Then it gets distributed automatically to all the other accounts in the system according to a predetermined allocation that you set up once and do not have to think about again. The ideal income hub is at a bank that offers early direct deposit, typically 1 to 2 days before the standard deposit date, because getting your paycheck early means your automatic distributions to other accounts can process before your bill payment date, ensuring funds are where they need to be before they are needed. Many online banks, including Chim, SoFi, and Axos, offer early direct deposit as a standard feature, and this seemingly small advantage in timing can make the entire system run more smoothly by eliminating the cash flow timing stress that arises when paycheck deposits and bill due dates are too close together. The income hub account should maintain a buffer balance, typically $500 to $1,000, that never gets distributed and never gets spent. This buffer absorbs timing variations in when income arrives and when automatic distributions go out, ensuring that a paycheck that arrives a day late does not cause an automatic transfer to fail, or a bill autopay to overdraft. The buffer is not an emergency fund. It is operational lubrication for the mechanical functioning of the system. Think of it the way a car engine needs oil, not the fuel that powers anything, just the thing that keeps the moving parts from grinding against each other. Account 2 is the bill payment account, and its entire purpose is to hold the money designated for fixed monthly obligations until those obligations come due. This is a separate checking account from the income hub. It can be at the same bank or a different one. Though keeping it at the same bank as the income hub makes the internal transfer seamless, and it receives a specific, predetermined transfer from the income hub on payday that covers all your fixed monthly bills. Rent or mortgage payment, utilities, insurance premiums, minimum loan payments, phone bill, any subscription that is a genuine ongoing necessity. Every fixed, recurring, non-negotiable expense has its amount sent to this account at the beginning of the month, and those funds sit there waiting to process when each bill comes due. The power of the bill payment account is that it makes your fixed obligations completely invisible to your day-to-day spending decisions. The rent money is not in your spending account to be accidentally spent. The car insurance premium is not competing with your grocery budget for the same balance. Each fixed expense has its dollars reserved in advance in a dedicated account where they wait until the due date and then process automatically through autopay. You never have to think about whether you have enough to cover rent this month because the rent money was sent to the bill payment account on payday, and it has been sitting there accumulating since then. The bill is covered before it is due. The cognitive load of tracking multiple due dates against a single fluctuating balance is eliminated entirely. Some people prefer to have their fixed bills auto-paid directly from the income hub rather than maintaining a separate bill payment account, and for people with very consistent income and very predictable fixed expenses, that simplification works. But the separate account approach has a significant advantage for most people, which is that it makes the boundary between fixed obligations and discretionary spending completely explicit. When you look at your spending account balance, which we will get to in a moment, you see only money that is actually available for discretionary use. The fixed obligation money is gone. It is in the bill payment account doing its job. The balance you see is the balance you actually have available to spend. Account 3 is the high-yield emergency fund, and this is the most important account in the entire system from a financial resilience standpoint. This account lives at a separate online bank from your income hub, specifically an online bank offering the highest available AP on savings, and it exists for one purpose and one purpose only: to cover genuine financial emergencies without requiring you to go into debt, liquidate investments, or disrupt your other financial systems. The emergency fund target for most people is 3 to 6 months of essential living expenses, not 3 to 6 months of total spending essential expenses only. Housing, utilities, groceries, transportation, insurance, minimum debt payments, the bare minimum cost of keeping your life operational for 3 to 6 months. Calculate that number for your specific situation. That is your emergency fund target. Until you reach it, a portion of every paycheck goes from the income hub to this account automatically. Once the target is reached, the automatic contributions stop and the balance simply sits there, earning whatever interest the high-yield account provides, waiting for the genuine emergency that may or may not ever arrive. The fact that this account is at a separate institution from your income hub and spending account is not an inconvenience. It is a deliberate design choice. When your emergency fund is at the same bank as your checking account and a single internal transfer moves money between them instantly, the psychological separation between emergency fund and spending money is thin and easy to breach. When a transfer requires initiating an ACH transfer to a different institution that takes 1 to 2 business days to arrive, that friction is a meaningful deterrent to using emergency fund money for non-emergencies. The 2-day wait is not a barrier to a genuine emergency. A genuine emergency can wait 2 days for funds to arrive, or it can be handled initially with a credit card that gets paid when the emergency fund transfer clears. But the 2-day wait is an effective barrier to the impulsive or convenient use of emergency fund money for things that are not emergencies, which is the use case you are trying to prevent. The interest earned on the emergency fund is a genuine benefit that compounds over time. 3 months of essential expenses for the average person might be $5,000 to $8,000. At a 4 to 5% APY in a high-yield savings account, that balance generates $200 to $400 per year in interest simply for existing and doing its primary job. On payday, a series of automatic transfers initiates from the income hub simultaneously. A fixed dollar amount goes to the bill payment account to cover all fixed monthly obligations. A fixed dollar amount goes to the high-yield emergency fund if the target has not yet been reached. A fixed dollar amount goes to the goals account, divided by goal and size to hit each goal on its timeline. A fixed dollar amount goes to the investment account to fund the brokerage or Roth IRA contribution. What remains in the income hub after all these transfers have processed is the operating balance for the month, the money available for groceries, dining out, entertainment, personal care, and all other variable discretionary spending, plus the income hub buffer. This remaining balance is your real spending money, not your account balance before the bills are accounted for, not a theoretical number that includes funds that are already obligated. The actual, genuinely available money for discretionary use in this pay period. When you look at your checking account balance after payday transfers have processed, what you see is what you actually have to spend. No mental accounting required. No calculation needed to determine what portion of the balance is already spoken for. The architecture has already done that work. Setting up this system takes 1 weekend of focused effort. The accounts all need to be opened if they do not already exist, which can be done entirely online in an hour or two for most institutions. The transfer amounts need to be calculated, which requires knowing your fixed expenses, your goal amounts and timelines, your emergency fund target and timeline, and your investment contribution target. The automatic transfers need to be configured, which is done through each bank's online portal and takes about 15 minutes per account once the amounts are determined. The bill autopays need to be configured to draw from the bill payment account rather than the income hub, which requires logging into each biller's website and updating the payment account on file. That single weekend of setup work creates a financial operating system that then runs automatically, month after month, without requiring the daily financial management decisions that exhaust people who are trying to manage everything manually from a single account. The system handles the routine. You handle the exceptions. And the exceptions, the unexpected expense, the goal timeline adjustment, the income change that requires rebalancing the transfer amounts, are genuinely manageable when the routine is running automatically in the background. The 5-account system scales with your income. As you earn more, the transfer amounts increase rather than the spending account balance swelling with unallocated income that gets absorbed into lifestyle inflation. The additional income goes to larger investment contributions, accelerated goal funding, or new goal accounts for the next priority on your financial list. The structure grows with you rather than becoming obsolete as your financial life evolves. Most people never build this system because nobody taught them it existed. They default to 1 or 2 accounts because that is what their parents had, what the bank recommended when they opened their first account at 18, what felt like enough at the time. And for years they managed their money reactively, from whatever balance is visible in whichever app they look at most often, wondering why the financial goals stay aspirational rather than becoming actual. This weekend you can change that. Open the accounts, set up the transfers, configure the autopays, and then let the system do what systems do run consistently, automatically, without requiring heroic daily discipline while your money flows to exactly where it is supposed to go every payday for as long as the system runs. Subscribe to Klux One Finance if you have not already. Hit the bell notification so you catch every video we release. Share this with someone who needs a banking system that actually works for their financial goals. And I will see you in the next one.